Hey everyone, here to go over some option strategies. Just quick disclaimer, I am not a financial professional. This is not financial advice. It is for education purpose only, educational. Anyways, so we'll start with going over some option strategies. And then of course, any questions, please let me know. So to start, I'll just cover the cash secured put. You could also do a naked put. Cash secured put, typically you want to go for probably around a 15 to 25 delta as your short. You could go a little higher if you want to be a little more risky. You can go a little lower, but you're going to get less premium. So like if I was looking at SPY today and I wanted a cash secured put, you could open like a 585. I'm going to get $544 today for this. My bet here is that SPY stays above 585 so that at a later date I can close this for less than 544, walk away with a profit. Your risk is technically undefined. You're either going to, if it's a naked put, it's an infinite risk all the way, not infinite. It's going to be 585 times 100 minus your credit received. And then, but if it's cash secured, your risk is just buying the shares at that price. So it's nice to open a cash secured put it's smart to open a cash secured put with the intention of buying the shares, worst case scenario. You definitely don't want to do this with a product that you don't want to own. Your max profit becomes your credit received to open the trade. An ideal environment for this, implied volatility wise, would be a high implied volatility because you want implied volatility to contract, therefore have the premiums decrease, allowing you to close for a debit less than the credit you received at a later date. And in this case, your assumption will be bullish or neutral. And then obviously the flip side of the selling is if you buy a put. And most people know what that means. That means you're betting on the stock going down, paying the debit up front. If I'm doing a cash secured put, I typically like to look to get about 2% of the credit received of my collateral. So let's pretend like this is cash secured. It's not going to happen in SPY, but cash secured put in SPY, you're looking at $58,500. You multiply that by 0.2. I'd hope to be collecting this premium. You don't get that. It's an ETF. You get about 1%. Some people go for the weeks. Some people go for the shorter term. I like to go 30 to 60 day. 45 being the sweet spot, but you can't always get there. And I always trade monthlies. Now, Tran, I know you talked about the wheel. So this would be if you're starting with cash, this is the first part of the wheel that someone's going to do. And honestly, because you're the only one in here other than rolling sushi, we could talk about the wheel if you'd like. Let me know below. This needs to be different. Oops. So, Tran or rolling sushi, you guys have questions on the cash secure put? That one's pretty straightforward. Okay. Then another one, the covered call. Oh, no questions. Thanks, rolling sushi. And Tran, if you got questions, let me know. Another one's covered call or naked call. And that's just basically you own, if it's covered, you own the shares of the stock. You pick a strike that you're happy with selling the shares at, and you receive money today to open that trade, and you're agreeing at a later date to sell the shares for $650 per share. The one thing to consider when opening a covered call is you must be willing to sell the shares, because that is a reality that could very well happen. So you need to really be okay with selling the shares, worst case scenario. Do not open. It's tempting. I have done it, and I have some wonderful stories. Do not open covered calls on shares you do not want to sell. So if you own 400 shares of a company Maybe open up 1 or 2 contracts. But now you still have 200 shares to play with if you blow past your covered call. The risk is technically undefined if it's naked. If it's covered, your risk is that your shares are going to be sold at the strike that you pick. Your max profit is your credit received. Ideal environment is for implied volatility is a high implied volatility. Similar to cash secure put, we want volatility to contract. Therefore, premiums go down. Therefore, you can close this for a debit less than the credit you received at a later date. Or, worst case scenario, you sell the shares if you really want to sell the shares. Your assumption is technically bearish neutral, but it could also be bullish if you're really wanting to sell the shares. If you're like, I'm done holding on to SPY, I want to sell it at 650, then you do have a bullish assumption. And then obviously the flip side of this is that you just buy a call, which, as we all know, if you buy a call, you're hoping for the stock to go up. If you sell a call, you might be hoping for the stock to go up to sell the shares, like I said, or you're hoping for the stock to go down so that you just collect kind of insurance on those shares. And it helps reduce your cost basis on the underlying effectively. I have shares in some stock that are now free because of covered calls and other things that I play with. So I see Rolling Sushi typing Tran. Just a moment. Let's go back to cash secure put. 1 second here. One question about the cash covered put. When you calculate the risk per trade, how do you calculate it? For example, let's say your stock trades at $50 with a premium of 50 cents per contract. Do you calculate the risk based off the potential of being exercised or the reversal in premium? When you say the stock trades at 50, is that going to be the strike that you pick to open the put, or it's just at $50? Okay. For me, I calculate the 2% return, the risk on $45, the strike. That's really only if it's cash secured. I know you're on margin account. You know, if you're on margin, you don't have to cash secure. Like I can open up a put at 610 on SPY today for $7,000 of buying power instead of 61,000. But if I'm doing it cash secured, I use the strike times 2%. I don't really think about the premium. I mean, it's good to consider your break even, of course. So your break even in this case, if we say it strikes 45 and you're collecting 50 cents, your break even is 44.50. Something to be aware of and to consider. I don't in my 2% calculation though. And then with the covered call, you know, I'm similar to cash secured put. I'm looking for a delta between 15 to 25. I might go up to 30, probably no higher. And then I'm also looking for 2%. And what I use for my 2% on a covered call is my cost basis. Not maybe the best way to look at it. Maybe you want to look at the current price. It's up to you on how you want to look at your 2% gain on that. I like to look at my cost basis because then I can go kind of further out the money and make it maybe still a little safer. Now, Rolling Sushi, when you say, can you go over an example, do you mean for the cash secured put? Okay, let's pick something with a little more premium juice in there. Let's go with SoFi. IB rank of 11, not great. Let's look at it anyways. So, and when you say, can you go over an example, do you just mean for the 2% calculation? Okay. So, you know, I actually saw someone on Reddit talk about this. And I think a good thing to do would be, depends how much you want to own, but I'd say I would just like, you could always just do like a one lot, go like, okay, you know what? I'm going to go for what delta is this? 13. Oh, yeah, let's go like 20 delta. Like, okay, just outside the expected mood, I want, oh, I see what you're saying. Yes, when I said 2 or 3% of your total portfolio, I meant just 2 or 3% on the strike. But if you wanted to do 2% of your portfolio, I think I would Yeah, that's what I was saying. It's just 2%. Like I would just do 2% of 18, and that's the credit I want to receive on this trade. But if you want to build a position in SoFi, to answer your question, and you want to go 2 to 3% of your portfolio, I mean, you could layer it in with a couple puts at the same time. Spread out the strikes maybe. Sorry, spread out the expirations maybe, but maybe not all at the same time. Um, but I think what I would do, yes, that is correct. 2% times 18 is $36 in premium. So like in this case, like this is, you're getting over 2%, right? You're getting almost 3%. What's 18 times 3? Yeah, you're getting close to 3%, but not quite. Um, good open interest, good premium. It's not a bad play. Bullish on SoFi long term. But yeah, I think to layer in like what you're saying is I would just, it depends on how many shares you want to own overall. Like if you want to own 200, I'd say like I'd go for a put, see if it gets assigned. If it doesn't, maybe the next month you open up another one, or the next month expiration you open another one. Just keep going until it gets assigned. And maybe you want to ladder it just to kind of give your better cost basis, or let yourself get assigned the 18, then open up another cash secure put. Allow yourself. You could even do if you wanted to do be willing to sell some of the shares you just got. You could even do like a covered strangle if you wanted to. Hmm. So, okay, good question. Related to you, what if you wanted to trade the position, didn't want to build the position? Where would you say your stop loss? So basically, pretending like this is naked, and I don't want to own SoFi. Yes, good question. I personally do not use stop losses a lot. Um, Mostly because if I'm opening a put in a company, I'm settling with I will own those shares, worst case scenario. I'm going to do my best to continue to roll. I think it's important if you want to set stop losses, you got to set what's good for your risk, your risk profile. I am not one to set a lot of stop losses. However, if this was to be tested and I really didn't want to own it, if this started to get tested, meaning that SoFi starts to creep down to 18, I'd probably wait until 18 was breached, meaning I'd go below 18. And then depending on how many days to expiration, I probably would look to roll this out to the next monthly, gain a credit, punt it out another month. If I'm ideally, as you know, we want to roll, if we can, we want to roll down and collect credit in a put. So it'd be ideal if I could roll this to a 17 and collect a credit, but never guarantee that you can do it. But the earlier you do it, the better, the more likely you are to be able to accomplish that. But it all depends on premium and IV and all that. But yeah, if it's a put, ideally I want to roll it down and out in time for a credit. If it's a covered call or a call, I want to roll it up and out in time for a credit. Ideally. If not, I have to do the same strike. But I think, if you want to use stop losses, I think that if you're like, you know what, I'm going to go with 100% of credit received. If I get to that loss, I'm going to move on. I think that's a fair way to approach it. I just, yeah, I just don't play around with stop losses too much. But I think with puts, part of it, the thing is that the market history has shown has always rebounded, right? So like with puts being tested, it's a little bit easier to sit in a put because eventually, depending on the stock, it's likely going to reverse. Whereas if you have a call that's breached, time has shown that the market actually goes down less often than up. So if your call's breached, then you might want to like worry about a stop loss, especially if a naked call, because the loss is legitimately infinite. Whereas a put is just that if the stock goes to zero, so whatever strike you got assigned to zero is your max loss. Yeah. So what if you're in a high process tech like Google or Berkshire Hathaway, where if it was signed to put, it'd be like $15,000. Yeah. I mean, I think that's, I guess for me is that it's hard because I open up puts on and I don't have the cash for all of them. I'd say like, oh, I guess my assumption would be like, hopefully I have a cash for at least one, and then I'm going to have to use margin, something I want to avoid. But the thing that's nice about a Google or Berkshire Hathaway, in your question, very reputable companies, companies that will rebound, they are not going away. So the nice thing is that even if you were using margin, you'd probably be able to maybe sell covered calls against it or something in order to help reduce your cost basis, and then also help against to offset that margin interest that you're paying. But it's a very good question. I think, you got to really go with your risk reward, your own tolerance of risk. Like if you're like, you know what, like I said, I received $100, I now have to pay $200 to close this, I'm going to walk away. I think that's a fair way to approach it. I've just had plenty of times where my, especially puts, have gotten tested. I continue rolling, and then eventually I decide not to roll. They get assigned, and the stock rebounds. Not always going to happen, of course, and it could be a long time frame for that happening. But I think you bring up a good question with stop losses because like I said, I've been playing around with naked calls a little bit, and I think that it's something to be considered if I'm going to play with naked calls is a stop loss. Like, you know what, I hit that, I'm going to move on. I think that's why I had a hard time with day trading and other trading is that I don't love locking in a loss. But hey, better to lock in a small loss than allow it to run. Tran, do you have anything with covered call or cash secure put? I can maybe go into detail with the wheel on that if you wanted to, because these are basically the two steps of the wheel. If not, I'll continue on some other strategies here. Okay. Well, if you got questions, just ask it below. So let's go back to, we'll just use that SoFi. So the next one I got is a synthetic covered call. So a synthetic covered call is you are selling an in the money put. So instead of buying the shares and selling a covered call, you're going to sell an in the money put, hoping that the stock continues to climb, and then you're able to buy this back for a credit less than you receive. Risk is undefined. It could be infinite, or you buy the shares at the in the money price that you've agreed to. Max profit is credit received. Ideal environment, implied volatility wise, you want high IV, same thing. IV contraction, which allows us to buy back for a debit that's less than the credit received. Your assumption directionally would be bullish and maybe neutral, but bullish. It's actually really just bullish because you want the stock to go up so that you can get out. You don't have to get assigned the shares at this high price. It's just a synthetic covered call. I mean, that's the way you can think of it. It's really just selling an in the money put. Something I haven't done very much, but not a bad option. Then there's leaps, which are like long equity. I can't remember what the acronym is, but for a leap, I think some people say 6 months. I try to go for about a year out. So like if I was to do a leap on SoFi, I'd go to probably the September expiration because it's over a little over a year. And I look to buy around a 70 delta. So I probably would buy the 17 here, maybe the 20. It depends on what I want to do, how much I want to spend. I like a higher delta on this, and in the money and higher delta is, as we know with delta, for every dollar increase or decrease in the underlying, the delta, then the options contract increases, decreases by the delta. So if I'm in at 70 delta call, and the stock keeps climbing, I'm getting 70 cents for every dollar of increase. Of course, delta is dynamic, so that actually is going to go up as I'm directionally correct. Your risk is defined on your debit paid to open this. So in this case, you'd open this up for $7.60, 160 bucks. That is your defined risk. Your max profit is unlimited because as the stock goes up, you're going to be able to get money from this and sell it for a credit later on. Ideal IV environment, I didn't really write one for this. I think you could do it either way, probably a low IV environment because you want IV to expand. Therefore, you're able to close for a credit higher than the debit you paid. And your directional assumption could technically be all because you could do a leap for the call or you could do a leap with a put if you think it's going to go down. So same thing, you just buy a leap put if you are bearish. And then I guess with the synthetic covered call, same thing. If you're bearish, you're just selling a in the money call and you're assuming that the stock is going to keep going down. That's probably why I wrote directional assumption. Bull and bear. Okay, then we got a vertical spread. Oh, I do not sell leaps. I would not recommend selling leaps. You really don't want to be locked into a covered call for that long. You know, a year, yes, the premium might look very nice to sell a covered call on SoFi at 30 bucks, but I wouldn't do that. For me, Rolling Sushi asks, what's the longest I would sell? If I was to sell a covered call or any short premium, I look for 30 to 60 DTE. 45 being the sweet spot. I mean, yeah, like if I was looking, let's just say I'm looking at SoFi to open a cover call today, I wouldn't go out to October, maybe, but that's pretty long. Like I don't want to be stuck in a contract, especially a covered call that long, or really a cash secured put. I'd rather look for probably anywhere. Once again, I don't trade weeklies, but anywhere from any of these September expirations, if I was going to trade a weekly, but I prefer to trade monthlies. Hello there, Bav fan. Thanks for joining. Okay, next on the list here, I've got vertical spread. Bav fan, we're just going over strategies, different types. If anything you missed, you can look at the YouTube video later and kind of see what you missed. Vertical spread. So vertical spread can be done several ways. You can do a call credit spread. You can do a put credit spread. You can do a call debit spread. You can do a put debit spread. So all different assumptions, a call credit spread and a call credit spread and a put debit spread would be bearish. A put credit spread and a call debit spread would be bullish. So let's just start with a put credit spread. So put credit spread would be that you sell a put, let's just pick a delta, between 15, 25, and then you buy a strike below that. So this caps your loss and your risk. This isn't a great example in terms of credit being received. This is a little low, but it's a way to go directional, cap your risk, cap your gain, of course, too. But here I'm basically saying, okay, I want SoFi to keep climbing up. If I'm right, I receive this 18 bucks, move on, or close it for less than the debit I paid. If you're opening up this, like I said, this is a bullish. Your max loss is going to be the width of the strikes minus your credit received. So in this case, it'd be like this says $80, 100 minus 18. Your max profit is just going to be your credit received. Oops. Sorry, guys. Let's undo that. So that's one. Then let's go for a call credit spread. call credit spread would be that you sell a option. Once again, I go for, 15 to 25, and then you're going to buy the strike above that. So in this case, we look at this, you could route this for a $16 credit. Once again, these are not great examples, but we're just going for it. You could route this for a $16 credit. This is a bullish trade. You're assuming neutral to bullish. You're assuming that SoFi will not hit 25 bucks here. Really, your break even is going to be 25 plus the credit, but we'll say 25 bucks. Your max profit is the credit received. Your max loss is the width of the strikes minus credit received. Ideal IV for credit ones, credit verticals, is going to be high IV because you want IV to contract, therefore be able to close for a debit less than the credit you received. This one, like I said, is a bearish trade. And then there are verticals where you pay a debit. So let's just go with like a bearish put. One would be you buy a strike and then you sell the one below that. Depends on whatever the width is your opinion on what you want to do. The more you do, the higher debit you're going to pay, but the higher your profit potentially could be. So in this case, this is a put debit spread. I'm paying, if I open this up today, I'm paying 45 bucks. My max gain is going to be the width of the strikes minus the debit paid. My max loss is the debit paid. And this would be a bullish assumption because I want SoFi to blow down. I want SoFi ideally to go below 20 in this trade. If it goes between 21 and 20, I could still walk away with some money, but I might not. And then a bullish example of the debit vertical is you're going to buy like a 22, sell a 23. So you're going to pick a strike to buy, and then you're going to sell the strike above it. So what I'm hoping for is for SoFi to keep climbing, similar to the put debit spread. My max loss is the debit paid. My max profits the strike width minus my debit paid. So in this case, it's going to be 100 minus 37, 63 bucks. My assumption here is directionally bullish. I want SoFi to keep climbing, therefore make a credit. It's a way to basically, when you go for the debit spreads, it's just a way to buy a call and buy a put while setting your risk. Like, it's a good way to kind of set a stop loss on your trade. Then that way you don't have to worry about a stop loss. It's built in. For the debit spreads, an ideal IV environment for a vertical debit would be low IV because you want IV to expand and then be able to sell for a credit higher than the debit you paid to begin with to open the trade. Yeah, that's vertical spreads. All four of them. Threw a lot out, you got all there. But any questions on vertical spreads there from anyone? With a vertical, so rolling sushi, how do you define that delta exposure? Do you mean with a vertical? Where to sell the short leg? So if we're doing and I'm assuming you mean like a credit spread. Oh, debit. That's a good question. I don't do a lot of vertical debits. I guess that really depends on how much you want to pay and what risk you want to take out on, right? So like if we looked at this one, let's just say you buy an at the money and you sell like let's go $5 out. Okay, well, I'm going to pay 113 bucks and I'm going to take good profit here, 387. I think for me, it wouldn't be necessarily the delta of the short. It'd be more of, for me, like, okay, if I buy this, my risk is $113 and I've got 387 max upside. I like that ratio. just a good risk reward ratio is what I think I would look for more than selling a delta for a vertical that's a debit vertical. Just kind of playing around with it there. I mean, obviously, I'd look at my overall delta, like a 32 delta. Okay, obviously, I'm bullish here. This is long delta. Yeah, I think me personally, I'm looking at risk and reward more than delta of my short on a debit vertical. Does that answer that? Yeah, you're welcome. What what do you normally do? I don't do much debit spreads. Honestly, I don't do a ton of them either. I've been doing a lot more lately. I think the thing that's a benefit of a debit spread, of course, when it's a vertical credit, you have a defined risk. But the thing I like about a debit spread is your risk is, defined. And you can do like with a butterfly, you can, like we showed with that Coinbase trade, is like if I opened a iron fly on Coinbase, I would have had a higher max loss than, let's say, $335. But I agree with you. Until more recently, I was more doing credit spreads rather than debit spreads. It's like I don't really want to pay up front. But I think a good mix of both is good. But it's really all personal preference. The thing that's hard sometimes, yeah, I guess for me, what I would say to you, you're saying I want to understand when they're applicable. I would say it depends on IV environment. And then yes, if risk reward is really attractive, it's another way to look at it too. But I think if it's a high IV, then you're probably, if it's verticals, we're going to talk about specifically. If it's high IV, you probably want to look for a credit spread because IV is likely going to contract. If it's a low IV, you might want to look at a debit spread because IV is going to expand, and then that way that helps you receive a higher credit at a later date. And with the credit IV contracting, pay a debit less than what you received to open the trade. Yes, honestly, the IV stuff is a more recent finding for me. I didn't really think about it that way with the contraction and the expansion. So I think that's what I would look at. And then also, like we just said, like good risk reward as opposed to a debit over a credit spread. You're welcome, no problem. Tran or Bav fan, you guys got any questions? If not, we'll move on. Sounds good, Rolling Sushi. Yeah, talk to you on Monday. All right, Tran and Bav fan. Have a good weekend, by the way. Rolling Sushi, and he left already. But okay, Tran and Bav fan, I'll keep going. But if you guys have questions, please feel free to ask. So an iron butterfly, we'll go to the next one. An iron butterfly is when you sell an at the money call and an at the money put, and then you buy wings. So you can set the width and they're going to be equidistant. So let's just go for 5 in this case, $5 wide. So you look to, you sell the at the monies. In this case, I'm going to buy since it's $22 strike in the middle here. Yeah, no problem, Bad Fan, if you're just listening. Tran, also, if you guys got questions. If not, this is being recorded. Y'all can ask me questions later on. So in terms of SoFi here with a butterfly, we're going to sell a $22 call, sell a $22 put, and then I want to go $5 wide. That's kind of up to you on with risk reward wise. But let's just do this for example purposes. I'm going to buy the 17, which is $5 below 22, and buy the $27 call. $17 put, $27 call. You can go narrower, you can go wider. If you go wider, you're usually going to increase more risk. If you go narrower, it's going to be less risk. So in this case, with an iron butterfly here, if you open this up, you have a credit of $2.80. That is your max profit. Your max loss is going to be the width of the spread, either one, doesn't matter, minus the credit received. So in this case, the width of the spread is $5. minus $2.90 makes your max loss $2.10, $220, $210. So when do you want to open an iron butterfly? Honestly, iron butterflies are very low pop. As you see, this is a 40% pop probability of profit. So they're not great trades. You can open them. You're going to want to close them after a certain amount, like maybe after 25% of max profit, just because it's usually not worth holding. You're not going to get this full 290. Ideal environment is going to be a high IV environment. As you see here with SoFi, IV rank of 10, low IV, not ideal. But you want it to be a high IV. That way, when implied volatility contracts, you can get out of this trade for you'll pay less than you received. And your assumption is going to be neutral because you want a SoFi in this case to stay around $22. Because if it stays within $22, you're able to close this for a debit less than you received, the credit you received to open it. And then just to show you playing around, like if we went to, like, let's just do $3 wide on each side here. Let's do $2 wide and see what happens. Yeah, so if we go like a $2 wide butterfly, okay, you're receiving $164 today. Your max loss is $200 because of the width of the strikes minus 164. So your max loss is 36 bucks. So if you're like, hey, you know what? I'm willing to take a gamble. I'm willing to accept that max loss, 36 bucks. You could open this up and just see what happens. Like I said, very unlikely you're going to receive that $164, but it's something to play around with. So that is an iron butterfly. Tran, you got any questions there? Okay, doesn't look like it. So, yes, Tran. What up? I'm driving also. Okay. Hey, I'm happy to be drive time listening for you both. Well, I will continue. Please, if you do have questions, please pull over and type. Do not type and drive if you can help it. Okay, so that's an iron fly. Then there is also a call or put butterfly. Now, these are more directional assumptions. So a call or put butterfly, let's start with a call one. You're going to buy a wing. Once again, it's equidistant two. So then you're going to sell two in the middle and then buy another wing that's equidistant. So in this case, for example purposes, I am buying, for SoFi, I'm buying a $22 call, selling two $25 calls, and buying one $28 call. You're going to route this for a debit. If it's a high IV environment, these are usually cheaper because premium is high, but then that makes it this cheap. So with these, it's kind of nice because if you are bullish on a stock, and assuming you get the longs correct, if it depends between the longs, your max risk is your debit paid. So in this case, we're going to route this for $51 debit. Your max gain is going to be the width of one of these. So in this case, it's equidistance, $3, right? So $300 minus 51, 250 bucks, $249 is your max profit. And in this case, this is a bullish trade, the call butterfly. You would like to do this in a high IV environment. You could do it in a low IV environment too, though. It just might be more expensive. The nice thing about this is it's a good, like, low probability of profit, not great. But the nice thing is that, like, for an earnings trade or something, you go directional, very low risk. Like if you open this up on SoFi, I'm making a directional bet in it. I'm spending $51 to do that. You usually want to form this out of the money. You could maybe have one of the legs, like you could maybe go like one leg in the money here. It's going to cost a little bit more, but that's kind of a way to structure it. And then if you're bearish, the flip side is a put butterfly. So if you look at the put butterfly, in this case for the put butterfly, I am buying a $21 put I am selling 2 of the $18 puts, and I am buying one $15 put. So I'm making a directional assumption here, and in this case, it's bearish. In this case, I'm going to pay $70 to open this trade. My max profit is going to be the width of the strikes minus the debit paid. So in this case, $300, because $3 width minus $70. And something I should have shown earlier is the analysis. So you see here in the analysis, if you pin between the longs, you will be able to close for a credit higher than you received. Sorry, you'll be able to close for a credit higher than the debit you paid. And obviously what your goal is to pin it exactly on your shorts. Probability of profit very low of that happening. But you look at probability of profit for 50%, 62%. So like there's a chance. Once again, directional bet here. This is a bearish trade. Defined a risk though, which is nice. Okay, then another one is a crab. Now, crab trade is basically a butterfly, but one of your legs, the longer dated option, one leg is going to be further dated, and that's going to be the lowest, if that makes sense. So I will show you what I mean. And you may have this longer leg be in the money or out the money. But if we look at it, you'd go to like, okay, let's go to October for SoFi. We're going to buy the $20 call in October. And then you go to September, you're going to sell 2 of the $23 calls and buy 1 of the $26 calls in September also. So this is just similar to a butterfly. It's just that our lowest leg of the butterfly type trade is further out in time. Kind of gives you more time to be right, and that more expensive leg option gives you more time to kind of be right too, like because you could technically have both of these, all of this close out of the money, and then SoFi keeps climbing and you get unlimited profit here. Now of course, if you're directionally correct in the short term, your max gain becomes the width of the strikes minus debit paid. So in this case, $186. Now that's if you close it with the September expiration still open. I have not done very many crabs. I've seen people on Tasty Trade do crabs. There's nothing wrong with them. I just haven't played around with them very much, but they're attractive trade. This would be a bullish example. If you want to do a bearish example, you would just structure it with puts. So we would buy like the $22 strike in October, sell 2 19s in September, and also buy a 16 in just one in September. Bearish trade, similar structure to the call crab, just that it's the opposite because it's a bearish trade. So you do either bearish or bullish. Max losses, debit paid. Max gain is kind of depends, similar to the call. If you close this while the shorter duration legs are still open, your max profit theoretically becomes with the strikes minus debit paid. Once again, similar to the call one though, if you allow these or close them early, allow these the short and the long from the shorter duration expiration close out of the money, then you still have this $22 put to be infinitely profitable. Once again, I have not done a lot of crafts, but they're nice little trades. Next, buying condom. Something I forgot to mention with like a vertical spread or we're going to get into these iron condors. I'll talk about it. I typically like to receive a credit that is equal to 1/3 the width of the strikes. So if I'm opening up a $1 width call credit spread, I want to receive 33 bucks. Gives you a 1 to 2 risk reward. That's just what I look to do. If you get more, that's great. Nothing wrong with getting more, but I wouldn't go for less most of the time. Sometimes you go for a little less. It's rough. It's not exact. But let's go for an iron condor. So typically iron condor is just going to be a call credit spread paired with a put credit spread. It's a neutral trade. For my shorts, once again, similar to the call credit spread and put credit spread, I'm looking for a delta around 15 to 25. Sometimes I'll go a little higher, mostly not above 30. Sometimes I'll go a little lower if it's profitable. And for the purposes of this, let's use the $2 wine. Yeah, see the credit receipt is kind of low on this, but that's because IV is low in SoFi. Let's see if we want to look at something else maybe. Let's look at Tesla just to see it's going to be, no, it's still low IV because they just had earnings. Let's look at NVIDIA. So NVIDIA, let's go for the 20 delta. No. Let's go for the 18 delta. Let's go $5 wide. And then I'd go for 18, once again, $5 wide. So $1.50, pretty close to 1/3. I think a third is what, 167. So it's close. It's not great. Now, this is a neutral trade. You want to do this. When I say neutral, you want to obviously make it, you want to have your call credit spread be above the current strike price or current stock price and the put credit spread below. When I say neutral, though, I look at the deltas. So if you look at my full position here, the delta's just barely negative, not even one delta negative. This is delta neutral because I'm selling the $18 call and I'm selling the $18 put. My hope for when opening this trade is that NVIDIA mostly stays between 200 and 150. I got a little more room with the break evens here. You'll see the break evens is green line, but my ideal scenario is to stay between my shorts. My break even really is 201.50 and 148.50 technically, but I'm getting that by doing the shorts. For the puts, short minus credit received. For the calls, call strike plus credit received. Now, your max profit is the credit received. Your max loss, also defined, which is going to be the width of either one of these strikes, and your minus your credit received. It is a neutral trade. You want it to stay in between these two shorts, like I said. Implied volatility environment that's ideal is a high implied volatility because you want it to contract, therefore pay a debit less than the credit received. You can also play around with these structures. You can widen just one side if you wanted to. It's going to increase your credit received, but it's going to increase your max loss too. It doesn't have to be equidistant. You can also play around with the short delta that the shorts on one side. Like if, let's say I'm a little more bullish than bearish, well, maybe I move this on the call side a little higher. That way, let's go 210, 215. That way, if NVIDIA has a really good rally, then I'm safer on this. So I'm a little long delta. It's still very low, but it's a way to kind of skew it. So that's an iron condor. And once again, if either of you have questions, please feel free. Iron condors are nothing wrong with doing iron condors. It's a way to do a straddle, but with defined risk, similar to a iron butterfly is a way to do an iron condor is a way to do a strangle with defined risk, and similar to how an iron butterfly is a way to do a straddle with defined risk, which we'll get to eventually. Some other ones that we got here are a synthetic stock trade. Now this can be done for bullish or bearish. Let's go bullish for now. But you're going to buy a around 50 delta call and sell around 50 delta put at the same time. Typically, this can be routed for a credit. The overall trade is then long 100 deltas, so you're long 100 shares of NVIDIA at this point. You're going to receive a credit of 34 cents to open this trade. Your max profit is unlimited. Max profit's unlimited. Your max loss is that you're assigned these shares 175 and they go to zero. That's your max loss. So when you're opening this, you kind of want to be sure that you're actually, long on the stock. You're looking for a directional move up and you close it. You don't need to sit in this. Not worth the risk. Now, of course, long term, if you're really bullish and you're happy with taking the shares at this higher price, that's a little bit out of the money. There's nothing wrong with it, or in the money, excuse me, with the put. There's nothing wrong with that. And then another way to form this, if you're short, if you're thinking like, you know what, I want to go synthetically short, is you're going to sell a call that's 50 delta, and you're going to buy a put that's 50 delta. I think I can stay here. Yeah. Now, in this case, we're going to have to route it for a debit, but if we go down here, we'll just do the show the debit version. Ideally, you want to route this for a credit if possible. But here you're synthetically short 100 deltas, so you're bearish on NVIDIA in this case. Your max loss is infinite because if this is not covered, you have a naked call here. And your max profit is, whatever the strike is that you are eyeing to zero. Minus plus the credit received, debit, well, subtracting out the debit paid, adding in the credit received. It's more ideal to receive a credit when you add out these trades because then that way it gives you more of a chance to be profitable. The pop on both of these is about 50%. And then just to show you the analysis curve, it's a bear trade. You're synthetically short this stock. It's another nice one to go long or short on a stock without having to own shares or short the shares. You're just looking for a directional bet here. Another one that actually Mate G from the Kingdom has showed me is called a risk reversal trade. This one is you're going to be, now I think you can do a bear bull here too, but we'll go for the bullish example first. Let's go back to SoFi. But you're going to you're going to buy a call that's probably a 50 delta, and then you're going to sell a put kind of wherever you're comfortable and what you want, and you're going to sell two puts. And the ideal scenario is to route this for a credit. And it's all about playing with what kind of credit you want to receive. Like if I went to this 26 delta, that's a $3 credit. It's very low, but all about risk, what you want the shares at, all of that. So in this case, if we look at this trade, pop is 63%, pretty close to 50%, which is what would happen if you owned the shares. Your delta is about 100 long. Your max profit is infinite here. Max profit's infinite. Your max loss is going to be the puts. So 19 times 200 minus credit received. This is a good one if you're bullish and then you're also picking a put that you're happy to assign the shares at. This is a good, nice little way to go along on a stock. And then the other way to route this, if you're bearish, is to, now these are going to be naked calls, so they're a little more risky, but so you would buy about a 50 delta put and you'd sell hopefully just two, but it could be more. Depends on what your risk tolerance is for the delta and the credit received. I mean, if you go for the 25, let's just say you're paying a debit, you might not want that. But, and also I like to structure it to look at my deltas. So ideally, if I was structuring this, I'd probably go for the 25, but at the pay at debit. So in this case, you're going to be buying a 50 delta put, 50 delta put, and then selling 2 or more. Probably going to go for a 1625 delta call on this, but you can go a little higher. It's all about getting that credit received and how many you want to open. So in this case, you are synthetically short 100 shares on this. You are looking you got a negative call here, so you want to be careful with this. Now, of course, if you own shares of SoFi, this could be covered, which is nice. But basically, you're synthetically short. You're making a bearish assumption here on SoFi in this case. And yeah, your max profit is going to be, the put that you're buying times 100 plus your credit received. That's your max profit. Your max loss is infinite because of this uncovered call, the naked call. Okay. Next, we got, and of course, if you guys have questions, I know you're both driving. If you guys, either of you, Bavfan, Tran, you guys got questions, please feel free to shoot them out here. Okay, another one is a calendar spread. This is a neutral trade. Ideal IV is low. What you're going to do is you're going to pick a longer dated, now this can be a call or a put, but we'll start with the call. You're going to pick a longer dated 50-ish delta call. Now, really, it doesn't matter what the delta is. It's more about the strike you want to pick that you think the stock is going to be at, if that makes sense. So let's just use SoFi. If we think SoFi is going to stay at $22 for a little bit, we're going to buy the $22 October 17th call. We're going to sell the $22 September call. You're going to route this for a debit. It's hard to know in the risk reward profile how this is going to look, but you're going to sell this for a debit. What you're hoping for is a low IV environment to pay a low debit to open this. Then that way in a later date, if IV expands, you could sell this for a credit higher than the debit you paid. It does have negative gamma exposure. So yeah, every dollar move, we are going to have a 1.77 delta move. That's a good point, Tran. It's really more of a neutral trade than anything. You're hoping that SoFi in this case stays at $22, but your max risk is the debit paid. Your max profit's somewhat unlimited because if the short expires out of the money, you have that long call still. I'm not super. If you got something to say about calendar, I'm into it. I'm not really too experienced with calendars. I've got one open right now on GameStop. It's not one that I'm super experienced in, but I see the benefit of them if you want to, and you can always do it like September's the long, and you go for a shorter day like August. I see sometimes people open these on round earnings. You got Fridge who does the double calendar. So Trans saying there's a strategy I saw where they find stocks with high exposure to make good gains. Is that the calendar or is that something different? It's related to high gamma exposure. Yeah, I mean, there's nothing wrong with looking at high gamma exposure. I didn't really know about gamma very well until I did that write-up for After Hour. I never really looked at gamma before. But it is definitely one to look at to know how your deltas are going to be affected with every dollar move. Yeah, gamma is not one I think many people look at. I usually focus on delta and theta more than anything delta. But gamma is a good one because if you are focused on delta, then it's good to know how your delta is going to change relative to the stock price with the gamma. With a calendar also, just to show everyone, we can do a calendar with puts. So same thing, we're going to buy a longer dated put and sell a shorter dated put at the same price. Max losses, debit received. Max profit, somewhat unlimited. It's going to be capped a bit, but hard to show in the curve, the analysis tab here, because it's just going to show a loss if you look at it, because it's just doesn't know how to calculate the max profit appropriately. It's hard to calculate the max profit on this. Once again, still a neutral trade. If you're doing puts, you maybe want to go down. You might want to go lower. So instead of, route this for around 20s or something. Like I said, I don't have a ton of experience with calendars. I have one open with GameStop. Going to kind of see how it goes. For now, it's been just kind of bouncing around. And yeah, it is a good one for ER plays, earnings plays if you're neutral. But once again, you can pick strikes that you think like, okay, like you can do to expect a move. Like, okay, well, let's pretend like it's earnings. I think that SoFi is going to be around the lower end. Let's just do 18. So then you center around 18. And if you want to center around the upper end of that, you would just pick the 20, 24, 25 in this case. And it's all about buying. You buy and sell the same strike, just different dates. And you can do these different, like you could buy the August 8th, sell the August 1st if earnings on the week of August 1st. You don't have to do only monthlies with these. You can go weekly. You can do whatever you want to do. It's the great thing about options. Now I got a diagonal next, but I'll wait for Tran's question here. Let's look at maybe Palantir. Let's do IBIT. IBIT's a good one to play with. Got good premium. No earnings. Ignore my strangle in here. So Tran says, so I look at the previous implied vol moves, and if they stay in the range or break it, so if the last 10 earnings had stayed within the implied move of 10%, then I usually look for condors. Hey, nothing wrong with looking at a condor if that's the case. A good way to look at past data to kind of make your assumption true. Condors are also not bad during earnings because implied volatility is usually high. Therefore, it's going to have an IV crash, which helps you profit once the IV crush happens, as opposed to, as you saw with some people who buy longs, and then IV crush happens and they're like, hey, I'm actually in the money, but I'm not making money. It's because IV crushed on their long call. Oh, that's a nice little tool you got there, Tran. Yeah. It's a good little strategy. Smart move. And if it works, it works. Do you mean strangle or you mean straddle? Because it's pretty neutral, other than a few outliers, well, recent outliers. Condor. Yeah. So strangle, but defined risk. Yeah, pretty neutral, other than a couple outliers here. The recent outliers, but okay. So moving on, we got diagonal. I'm gonna look at IBIT for this. A diagonal is buying. Let's go for a call diagonal, which is a bullish trade. You're gonna buy about a 50 delta call in the longer date expiration. It can be any. I'm just gonna use monthlies as the example, and then we're gonna sell a strike above the long in a shorter dated expiration. It's all about risk and reward here. So, you could look at this is not a great one to show diagonal now that I just realized it. You know what? Ignore me. Let's go look at SoFi. Sorry, everyone. Let's look at SoFi. Let's just do a bullish diagonal in SoFi. So you're going to buy the $22 call in October, And let's sell the $27. So it's a $5 wide. I'm going to pay a debit of $158 to open this. Defined risk. My max loss is this debit paid. You're long a little delta here. The max profit's hard to calculate because technically you could allow this short to expire out of the money and then you still have your long call at $22. As you see here, it doesn't really ignore my shares there. It shows you a profit, but it caps it off as if this is a vertical almost. So technically, if you blow past your short here, you could make over the width of the spread up to a point. So if you get too past 27 in this case, you're gonna lose extrinsic value as it gets higher and higher. So, the max profit, technically unlimited, I look to think of it as the width of the spread as my max profit minus debit paid. So that in this case, okay, well, my max loss is 158. My max gain is $5 minus 158, what, 342? So it's like a decent risk reward to kind of go in. Good way to go bullish with defined risk. And on the flip side, you could go bearish using puts. So we would do like buy a 50 delta put. Could be slightly in the money, could be out of the money. That's up to you on your risk profile and how much you want to spend. But let's go slightly out of the money. And once again, we'll go for like a $5 width. So I did the 21, we'll go to the 16. So similar to the other one, we are paying $1.72. We are short a few deltas here, about 35. My bet is that SoFi is going to decrease. We're looking for a directional move to close it. Once again, I consider my max profit technically, although it's not true, about the width of the strikes minus debit paid. You could make more because the short could expire out of the money. You could be directionally right and make infinite on this put that you bought. Ideal environment to open these, low IV, you want IV to expand. Therefore, you can close it for a credit higher than the debit you paid. Hey there, hey Doms, just going over different strategies here. If you got questions, feel free to type them. We're pretty decently down the list here, but if you have, please feel free to ask questions. Okay, next up we got a Jade Lizard. Let's go to IBIT for Jade Lizard though. So a Jade Lizard, very funky name, I know. Can I take these off? Okay, we'll ignore my existing position here, but Jade Lizard is done two different ways. So Jade Lizard is either a cash secured or naked put paired with a call credit spread, or a cover call or naked call paired with a put credit spread. And I'll show you guys what I mean. So let's start with the cash secured put. So with the put side, and the naked side, either that be a naked call or a naked put, we're going to look for a 15 to 25 delta. Could go up to 30, depends on what your risk tolerance is. So let's just look at a 20. Let's go to the 57 since it's just outside the expected move. This for $1.29 by itself. If I pair it with a call credit spread, let's go outside, just inside the expected move here, just to see. No, what are you doing? What are you doing? Okay, there we go. So in this case, we are selling the $57 put, and then we are selling the $70 call and buying the $71 call. Okay. If we look at the curve here, what's nice about, ignore my existing position. What's nice about a Jade Lizard, let's zoom in a little bit so we can get a little better view of this maybe. There we go. Nice thing about Jade Lizard is, in this case, this is going to be a bullish or neutral trade with a put paired with the call credit. If we are in between our shorts here, we get maximum amount of credit received. We just collect this 156. That's all we get. That's our max profit. If IBIT keeps on climbing and blows past our long strike here in the call credit spread, we still walk away with some money because ideally you want to route this for a credit larger than the width of the credit spreads. So in this case, You'd lose $100 here, but you get this for $156. So I walk away with 56 bucks in this case, if it was to keep climbing above. So it's like a neutral trade with some upside protection. You can't always route these for a credit higher than the width of the spread. It is ideal to do so. Your ideal environment for implied volatility is a high because, once again, if IV decreases, which is what you want when it's high IV, you can then close for a debit less than the credit received to open it. Your assumption, like I said, is neutral. This could be neutral / slightly bullish, maybe. And in the case of the put, your risk is technically infinite, not infinite, but if it's cash secured, your risk is that you buy the shares at $57 per share. And then the other way to do this trade is the flip side of it. And I would pair it with a covered call if I did it, but let's go like a 20 delta. Let's do 25 delta. So let's just say a 72 strike call paired with a put credit spread. And let's go a little further, collect a little less money just for the purposes of this. Okay. So if we look at this, this is a, come on. There we go. There we go. This is a covered call or a naked call paired with a put credit spread. So similar, this is a neutral kind of bearish trade. You want to stay in between your shorts here. Once again, if you're wrong, if this keeps going down, you still walk away with some money because your credit is over the width of the put credit spread. If you keep going up, this is where you get into loss territory, but that's why it's good to pair this with a covered call, and you're picking a strike that you are happy to sell the shares at. You could do this naked. That's all about your risk tolerance, though. Your max profit is the credit received. Your max loss is infinite if this is uncovered. If it is covered, your max loss is really just money left on the table from a covered call standpoint. Jade Lizard, I think, is a good way to kind of get a covered call and juice some extra premium with a put credit spread. I like to do these. If I'm wanting to do covered calls and want some more premium, I will do these instead of just a covered call. Or if I want to do a cash secured put on a company and I want to get a little more premium, I'll do it with the cash secured put. Do I have a win rate for Jade Lizards? I don't do a lot of Jade Lizards, but it's a high probability trade. I mean, you look at this one, this pop is 78%. You know, it's a pretty high probability trade because other than, you know, leaving money on the table or being assigned shares, you can be directionally wrong the opposite side of the naked one and still walk away with money. Because ideally, like I said, you want to route this for a credit greater than the width of the spread. I like Jade Lizards. Another one I like with using cash secured puts and covered calls is a ratio spread, which we will get to in a little bit here, assuming time allows. So the next one I have is a zebra, which is the zero extrinsic back ratio spread. This can be bullish or bearish, but what you do is you buy two 70-ish delta calls. Let's go bullish first, and then sell an at the money call against it. Just one though, not two. So what's going to happen is and it depends on how this is structured. You know, sometimes it's going to be a little bit different. Let's just go for the 68 delta for this, but you're going to go around 100 deltas on this overall position. It's about a 50% pop, in this case 45, because you are synthetically long 100 shares roughly on this. This is a bullish trade. Your max loss is the debit paid. Your max gain is infinite because, yes, if you blow past the short here, yes, one of your longs gets called away at the $500 gain here, but you have one more call, which is going to keep going long. And the reason that you do it this way is that you can help to go synthetically long. Ideal environment is a low IV because the lower the IV, the less you have to pay on the debit, which you see like with IBIT, high IV stock. it's going higher IV stock, I should say. The debit's pretty high on this, but this is a good way to go long without owning the shares, especially if you do not have the money to own the shares. You look at this, I'm spending $959. That's a fraction of what I have to pay to buy 100 shares of IBIT today, about 1/6. And then you can flip this around and do a bullish. So you can buy a um, 70 delta, 270 delta puts, and sell an at the money one put against it. So in this case, we'd route this with buying two of the $69 puts, selling one of the $64 puts. You're synthetically short 90 deltas, close to 100, 50% pop, 53%. Your max profit, your max loss is going to be the debit paid. Your max profit is obviously going to be the longs minus the debit. Am I doing that math right? Well, your max profit's basically the longs to zero, right? So in this case, it's $6,500. Thank you, Tran. I try my best to have golden nuggets. So this is a way to synthetically short the stock, define risk way. This is a tasty trade. Zebra is a weird name, but it's a tasty trade one. Once again, low IV environment, like the bullish example. It's a great way to go. Yeah, it's a great way to go short or long for a low amount of capital, especially if you don't want to short a stock or go long on a stock by buying or shorting it officially. Another one we got. I'll wait for your question here, Train, if you got a question. I think we might be able to get through all of them today. I don't think we'll have time to go over the wheel specifically. I think before you got in here, I was talking about, or you just got in, but you were driving. I was talking about cash secured puts and covered calls. I think next week we'll maybe go into the wheel a little more in depth, but cash secured puts and covered calls are the wheel essentially. I think next Friday maybe we'll do it if you can make it. So yeah, just plan on next Friday because I think I'm going to be able to get through all of these, and then that way we can have time to talk about it next week. I just don't have enough time to do all of these and then go over wheeling. The next one we'll look at is the broken wing butterfly. Broken wing butterfly can be done with calls or puts. We'll start with the call example. Basically, if it's calls, you are technically bearish on a stock. And for the short end of it, you're going to want to pick around a 15, 20 delta, 25 delta. It depends on how much money you're going to get. Let's see. Let's do a $3 and a $6. What's that going to get us? No. Let's do a $2 and a $4. Okay. Do a 2 and a 5. So, broken wing butterfly could be calls or puts. We'll look at the calls first. In this case, we're going to be buying a $71 call, selling two $73 calls, and buying one $78 call. The way you want to route this is for a credit. You can route it for a debit. Just remember that's going to be your max loss, or it's going to add to your max loss, I should say. But it's ideal to route it for a credit because, like if we do a call broken wing butterfly, our assumption is bearish, but we have it built in that you can get a gain if you pin the shorter spread here. Basically, a broken wing butterfly, if it's a call, is a call credit spread paired with a call debit spread. Call credit spread paired with a call debit spread. The call credit spread, in this case, the credit spread is going to be wider than the debit spread. And that makes it so that, assuming you're right, bearish, if IBIT stays below $73, you're going to, at worst case, walk away with $17, and best case, maybe a little bit more. If it stays below the break even here, you're going to still walk away with some money. And then, of course, as we start to near past the break even to the all the way to the long, you start getting into your max loss situation. So your max gain on this is going to be your credit received plus the distance of the debit spread in this broken wing, and then your max loss is going to be the distance, the math of the call credit spread, the width of that minus the width of the debit spread minus your credit received. So you look at this is 78 minus 73, that's $500. Then 73 minus 71 is 200. So you do 300 minus 200, gives us $300 as your max loss, but then you have to subtract out this credit of 17, max loss is 283. Kind of complicated to think about, but that's the broken wing butterfly. You want to do it in a high IV environment. You could do it in a lower IV environment too, though. Both work. And then that's going to be your, in this case, this is a bearish trade. Another way to do it is the puts with puts. And so we structure it the same. Let's just go with the 30. No, let's go with the 25 as our short, and we'll structure it the same. We'll do a 2, and then a 1, 2, 3, 4, 5. Okay, so in this case, we're going to be buying a 60, selling 2 of the 58s, buying a 53. This would be a bullish trade because you're hoping for IBIT to stay ideally above the break even here. I mean, obviously, a super ideal is to pin it between your to the shorts here, but low probability of that happening. However, if IBIT stays above your long, your highest long in the put, you're going to walk away with $25 no matter what. Max gain, similar to the call side, is going to be the width of the debit spread plus your credit received. Max loss is going to be the width of your credit spread minus the width of your debit spread minus credit received. In this case, 275. I like broken wing butterflies. They're nice little ones to go directional. It's nice to have that built-in gain here. I think you want to open them. You're asking if they're better for low IV. I think you want to open them in high IV more than low IV because you are opening it routing for a credit. I'm showing it with a low credit received, but you want IV to contract and then hopefully walk away, without. Yeah, but I do see, I think, what you mean with that, because if you do pin it here, you want IV to expand here because this actually helps you. But I think it makes it harder to route it for a credit if it's a high IV, I believe. But this is all directions. I mean, this is really neutral bullish trade. If it's a call, it's a neutral bearish trade. These are nothing wrong with these. I like doing these every so often. Nice way to bet on a direction and be right. And you can manage these later on. You can buy in your risk to make it risk-free. I haven't done much of that, but you can do that. Okay, then next we got ratio spreads. So either be a call ratio spread or a put ratio spread. I like call and put ratio spreads. They're nice ways to do, similar to the Jade Lizard, more juiced versions of cash secured puts and covered calls. So what I would do is my shorts around the, once again, 15 to 25, let's go for a 20. And then you pick a long above the shorts in a put situation. So we're going to start with the put ratio spread. But in this case, we're going to route this, and the width depends on your risk tolerance and how much money you want to receive and all of that, and then how much you want your max profit to be. But basically, this is a debit spread paired with a cash secured put. So it's a nice way to do a cash secured put and juice a little bit out if your short starts to get tested here. So in this case, your max profit is going to be your credit received plus the width of these strikes. So in this case, $285, because this is $2 wide plus the 85 credit. Your max loss because this is technically a naked put or a cash secured put, is going to be the $57,000 minus 200 minus credit received. 200 because it's the width of the put debit spread. This is a neutral or bullish trade. You ideally want your short really to not get tested. However, if you did get it tested, it works out well because of this debit spread is built in. I kind of like these as a way to get extra little juice out of my cash secured puts if I'm going to do a cash secured put. The nice thing about these two is, let's just say IBIT keeps on climbing. Well, I could at a later date buy the $55 wing of this for less than 85 cents, hopefully. And if I do that, then I create a risk-free butterfly. To show you what I mean by risk-free butterfly real quick, I'll open up this MetaTrade. So this MetaTrade is a risk-free butterfly for me. I ended up buying a wing at a later date for less than the credit I received to open it. And so no matter what happens, if I end up above my longs, I still walk away with the difference of credit received and debit paid for the wing. But I still have this additional bonus if I pin my shorts. So I really like ratio spreads in that way. It's a really nice to get the risk-free butterfly. Of course, it doesn't always happen, but it's nice. And then another way to structure this is with covered calls or naked calls. And you're going to, let's just go for the 24 delta. You're going to sell 2 of those. You're going to buy, and we'll do $2 widths like we did with the puts. So this is a call ratio spread. Once again, I usually do these covered. You can do these naked though. I've done a couple naked. I don't love doing naked, but you can do them. So this is another one, basically a covered call juiced. And then you can also structure these differently. Like they don't have to all be, you don't have to sell 2 here. You could sell one at 72 and you could sell another one at 74. Like you can give yourself a little room if it's going to, especially if it's naked. Oops, so. It's a way to do it. You're going to lower your credit, but that's a way to play with it. Anyways, look at the traditional one, though. So similar to the opposite of the put one, this is a bearish trade, neutral bearish trade. Of course, if you're a little wrong, you got that built-in gain. Your max gain is credit received plus the width of the debit spread. In this case, it'd be 200 plus 1. Max loss is infinite if this is naked. Or max loss is really, if it's covered, money left on table like we talked about with covered calls. And then once again, similar to the put side, if you later on IBIT keeps on going down, you could buy in the risk here of this wing for less than $81, lock in a gain, and have that upside if it later reverses direction, risk-free butterfly. Great, nice little bonus there for the ratios. Then we got straddles. I have a straddle on, actually, an IBIT here. Excuse me, that's a strangle. Never mind, we got straddles. Excuse me, ignore me. So a straddle is an iron butterfly with undefined risk. We are just going to sell 2 at the money. At the money puts and calls. Sell 1 at the money put and sell 1 at the money call. Undefined risk. Your max risk is undefined. This is a naked put, naked call. You could do this covered, though, if you wanted to be. You could theoretically have a cash secured put and theoretically have a covered call on this. Your max profit is the credit received. Max loss, technically infinite. Ideal environment for this, high IV, also with call ratio and put ratio. I didn't mention it. High IV environment is also ideal. This is a neutral trade. Your break evens basically become the strikes plus or minus, if it's a call, plus the strike of the call plus your credit received, if it's the strike of the put minus the credit received. This is an iron butterfly with undefined risk. Then another one we got is the strangle. So a strangle, you try to make these delta neutral. Let's just pretend like we're opening a new strangle. Let's go for a $21 put, 21 delta put, and a 21 delta call. So this is a strangle. It's a neutral strategy. You are ideally hoping, now you structure this could be different than neutral, but we'll start with delta neutral. Ideally, you want to structure this delta neutral, or technically you do, doesn't mean you have to. Undefined risk, it is an iron condor with undefined risk. You could do this covered. You could have a cash secured put and a covered call here. It's nice when you have a stock that you're okay with selling, but also okay with buying. Max gain is credit received. Max loss, technically infinite if this is naked. Ideal IV environment is high. This is a neutral trade. You can structure these skewed to kind of play into it. You could say like, okay, I want to give myself more room to the downside. You move a shorter delta here. It gives you a little bit of delta, bearish delta. You could do the same thing where you're like, I want to give myself some more room to the upside. Make yourself a little delta positive. Just the way you want to play with your own risk reward there. Nothing wrong with doing strangles or straddles. Also nothing wrong with making them defined. One more we got, two more we got. Poor man's covered call. So poor man's covered call is really a leap. So you're basically, instead of buying shares, you're buying a leap. So we'll go like a year out here. Let's go to January 2027. Buy about a 70 delta leap call. And then you sell shorter dated calls against it. Up to you on what expiration you want to pick. But you'd buy this leap and then sell calls against that leap. Thing you want to be aware of is your break evens here. In this case, we're looking at a loss because I'm paying $18 to open this, almost 19. My strike is the 57. Well, really, my break even is 57 plus 19, which is what, 76. So you really want to make sure your short call is accounting for that. So if we look here, yeah, so this is a small gain now. So that's the poor man's covered call. That is a bull strategy. Max risk is debit paid. If you continue to do this and your short strike continues to be expired out of the money, you continually reduce your premium paid, which helps reduce your cost basis. And it makes it nice because you could technically eventually, if you continually have that short being expiring out of the money, you could potentially have a free leap or a very cheap leap. Of course, the downside of that is you cap your gain. It's a stock that grows super quick. You have agreed to sell a short against it that's well below what it's at now. You capture gain. That's kind of a bummer. And then the poor man's covered put. Of course, if you got a question, anyone, please. Poor man's covered put, not one I have done a lot, but I think it's very similar. You are going to buy a 70 delta put. And then sell shorter dated puts against it. Same thing, be aware your break evens. Yeah, beware your break evens. Like you don't want to sell this and make it so that you lose money. So this one, you're aware your break evens, you're making money. Once again, I don't love doing the poor man's, but if you cannot own the shares, it's a good way to go long or go short and effectively continually reduce your cost basis. There's nothing wrong with that. Trend love, how would you set it and forget it? Like through CSP and covered call? What do you mean exactly by set it and forget it when you say like CSP or covered call? Can you hear me now? Can you hear me now? Can you hear me now? How about now? Okay. Well, we'll see if it's you. I do have to go pretty soon here, but I saw Rich Hammond. Thanks for joining. Do you have any questions, Rich? You still can't hear me, Tran? You can hear me now? Okay. Sorry, I worded that funny. And Rich, if you got any questions, I got a couple more minutes here. Um, so Tran, just wanted you to clarify your question. How would you set and forget like through CSP and covered call? What do you mean exactly? So you don't have to monitor. I guess the big thing would be similar to a covered call or a cash, similar to a covered call is that you're going to pick a strike that you're happy with if it gets assigned for a poor man's covered call. And then, as that short gets expired out of the money, then you just open a new covered call, longer dated. That's kind of a way to play with it, be less monitored. Does that answer your question? Uh, I guess. Well, how could I help clarify it, Tran? For the zebra, go ahead. Well, with the zebra, the max loss is defined at your debit paid. Yeah, so your zebra, like if we just look here on iBit for zebra, now this is going to be an expensive product to do it. But if we look here, now I'll go with the curve analysis just to show you too. But this is a long zebra. Your max loss is 959. It's your debit paid. No, no worries. No need to. No big deal. Um, yeah. So I think if you have more questions, feel free. I got a couple minutes, but I think next week we'll try to look at the wheel. Um, but more than anything here, I just wanted to focus on strategies. I always hope. You're welcome. Thanks for joining. Happy to have you here, and I'm happy to cover the wheel next week. I'm gonna close this out and either upload the YouTube video today or tomorrow, maybe Sunday, and then I will post it in the kingdom here. I'll probably post it in my channel. Um, I also obviously it'll be uploaded to my YouTube too, which is I can send that out. But well, you're too kind. I'm not quite a legend, but yeah, no problem. You're welcome.